A very good morning to one and all, and welcome to Investment Outlook 2014. We request everyone to settle down. We shall start the program in the next 5 minutes. May I request all the guests to please rise for the national anthem.
जन गण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंधु गुजरात मराठा द्राविड़ उत्कल गंगा विंध्य हिमाचल यमुना गंगा उत्कल जलधि तरंगा तब शुभ नामे जागे तब शुभ आशीष मांगे गाहे तब जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे.
I now request our chief guest, Mr. U.K. Sinha, SEBI, Chairman SEBI, Mr. Shailesh Vaidya, President IMC, Mr. Prabodh Thakkar, Vice President IMC, Mr. Ashish Chauhan, CEO BSC, Mrs. Deena Mehta, Chairman Capital Market Committee, Mr. Ashokan, Co-Chairman IMC, Mr. S.K. Roy, Chairman LIC, and Mr. Atul Mehta, ICS of India, to please come for the lighting of the lamp. I request all the dignitaries to please take up seats on the dais. Before we begin with the event, please put your mobile phone on silent mode, and for security reasons, please wear all your badges. Mr. Shailesh Vaidya is a practicing advocate and solicitor. He is a partner at Messrs. Kanga and Company, a reputed firm of advocates and solicitors, which is 124 years old law firm in India. Mr. Vaidya is currently the president of the Indian Merchants Chamber. He has been the member of the managing committee of the IMC since the past 8 years. I now request Mr. Shailesh Vaidya, President IMC, to deliver the welcome address.
A very good morning to all of you. Mr. UK Sinha, Chairman SEBI, Mr. SK Roy, Chairman Life Insurance Corporation of India, Mr. Ashish Kumar Chauhan, MD and CEO of Bombay Stock Exchange, Mr. Prabodh Thakkar, President-elect IMC, Mrs. Deena Mehta, Chairperson, Capital Market Committee, IMC, distinguished guests in the audience, dignitaries, speakers, ladies and gentlemen. It is my pleasure to extend to all of you a very warm and hearty welcome for the Investment Outlook 2014 organized by the Indian Merchant Chambers Capital Markets Committee. At the outset, I extend a special welcome with gratitude to Mr. UK Sinha, Chairman, Securities Exchange Board of India, and Mr. SK Roy, Chairman, Life Insurance Corporation of India, who have spared their valuable time to be here with us today and grace this occasion. I must also welcome and thank all the other eminent speakers of all the sessions throughout the day who have kindly consented to be with us here today. A special word of thanks is also due to our co-organizers, the Institute of Company Secretaries of India and the Bombay Stock Exchange, who have supported us in this endeavor. There is no doubt that this is an excellent opportunity to learn, share, and pool our intellectual resources for the mutual benefit as well as for the investment community at large. The Indian financial system is rich in its innate potential, and the need of the hour is some out-of-the-box thinking to help unleash this. To introduce our chief guest briefly, Mr. UK Sinha, as we all know, is currently the chairman of SEBI. He is a member of the Indian Administrative Services belonging to the Bihar cadre. He has earlier served as Joint Secretary in charge of capital markets. He has been a part of various committees formed by SEBI and the Finance Ministry for capital market regulations and brings to the table a unique combination of knowledge and experience. Our guest of honor, Mr. SK Roy, currently Chairman of LIC, served as a Managing Director of LIC since June 2013. He is a guest faculty at the Management Development Center of LIC at Mumbai and the National Insurance Academy, Pune. He has undergone training programs at the Indian School of Business, Hyderabad, and the Asian Institute of Management, Manila. He holds a postgraduate degree from Delhi University and a PhD from the University of Warwick. We are honored to have both Mr. Sinha and Mr. Roy with us today. Ladies and gentlemen, please join your hands together to welcome our honored dignitaries. I would now briefly apprise you all about the Indian Merchant Chamber. Established in 1907 and headquartered in Mumbai, the Indian Merchant Chamber is an apex chamber of commerce, trade and industry in the western region with a membership base of over 3,200 members and 220 trade associations affiliated to it. Together, we represent and advocate the interest of over 3 lakh business and industry establishments from diverse sectors of the industry. We have over 35 industry-specific committees of experts through which we provide policy inputs and recommendations at various levels of government authorities. The theme of IMC this year, ladies and gentlemen, is sustainable development, which is committed to the overall growth and development of all sectors and all sections of society in our country. IMC programs this year have primarily revolved around this theme. We also continue to maintain a strong focus on key sectors like banking and financial services, environment, water resources, tourism, education, and also insurance. We regularly organize meetings with senior policy makers to express and drive home our views. As we all know, forecasting the future is difficult, especially in this period of protracted uncertainty. All over the world, investment cycles and business confidence continue to remain weak. Highly leveraged balance sheets continue to act as deterrents to the sustained revival of the investment cycle. In India, the looming elections are adding to the uncertainties of governance, regulation, and entire administrative framework in a manner which is not very conducive to market development in almost every major asset class. Nevertheless, we remain optimistic and believe that this is just a passing phase. Once the new government settles in, and hopefully with a clear majority, we will regain the lost sheen. We will then have a rapid development sphere helping address the fundamental socio-economic issue of inclusiveness and sustainability. That is because the underlying institutions necessary for market development are already well established in India. We can see our markets gradually bouncing back and guiding the economic transformation of the country. On the domestic front, there are several positives shaping up, including a narrowing current account deficit, healthy capital inflows reining in of the fiscal deficit, bottoming out of the GDP growth, a likely boost to investment post the general elections, and an easing of food inflation. All this will probably be a respite from the high interest rates in the economy and facilitate the much needed investment. This will then allow the development and expansion of market forces to play a positive role in promoting sustainable growth. Whatever the merits and demerits of our political system, years of experimentation have given policymakers a first-hand experience with the pros and cons of a market-based system. The consensus regarding economic reforms that has been developed so far, as well as the infrastructure building initiatives undertaken by the government, will help provide a positive environment to propel the future growth and sophistication of markets in our country. Post-election, we also expect some major structural changes that will increasingly transform the economy to one that is more market-based, investor-friendly, and avoids over-regulation. In this regard, we are already existing dynamic financial institutions have an important role to play. As our businesses begin to operate under more transparency, better legal protection, advanced technologies, global compatibilities, there is reason to believe that our financial markets will grow and continue to grow at rates well above the average. Once we are through with the elections, greater policy certainty is likely to drive the announcement of new ventures and a sustained revival in the investment cycle that would bring in the feel-good factor. In conclusion, I would like to congratulate and thank Mrs. Deena Mehta, Chairperson of our Capital Market Committee, as well as all those who have worked diligently and proactively behind the scenes for organizing this highly interesting and relevant conference so meticulously. This unstinting cooperation has ensured a maximum attendance today, and this ensures the success of this mega event of our chamber. I wish the seminar all success. Thank you all very much.
Thank you, sir, for your valuable insights and for highlighting the theme sustainable development. Mr. Ashish Chauhan is the MD and CEO of BSE Limited, Asia's first stock exchange. He serves on the board of ICCL, CDSL, BSE Institute Limited, BSFI Sector Skill Council, and Marketplace Technologies. He has 22 years of experience in financial markets and technology, and he holds a BTech in Mechanical Engineering from IIT Bombay and a PGDM from IIM Calcutta. I now request Mr. Ashish Chauhan, CEO BSE, to address us.
Shri UK Sinha, Chairman SEBI, Shri SK Roy, Chairman LIC, Shri Shailesh Vaidya, President IMC, Shri Prabodh Thakkar, Shri Atul Bhai, Shri Ashokan, Ms. Dina Mehta, friends, ladies and gentlemen, I would like to congratulate all of you to this, congratulate and thank IMC for arranging this conference. This hall used to be the trading floor of Bombay Stock Exchange, and now we have converted into a convention hall. It's an interesting journey of BSE for last 140 years. Today, BSE has first time reached a market capital. In fact, India has reached the first time the market capitalization of 75 lakh crore. BSE has been a catalyst in creating this wealth. There are two types of agencies in the country which basically help create wealth. One is the banking, what we call intermediation part, and then there are institutions like exchanges which are disintermediation. In banking, it's done on principal basis. So you give money to the bank on a principal basis, and bank on lends to the industrialist or anyone who needs money. And if they fail, still the bank has to make it good. In between, there are a lot of NPAs, but you are not supposed to be worried about because the banks will make it good somehow. In the stock markets, the exchange doesn't create money, nor it holds money for you. It only helps the investor invest with the company. It's like a priest. Once you invest in the company, it is between husband and wife, between the investor and the company. And that's why there are no NPAs we have. Everything what you see on the screen is what we call mark to market on the real time. And that's where when you compare Indian banking system of 80 lakh crore total wealth which is represented there, out of which around 28 lakh crore is in government bonds and other things. 52 lakh crore is with actually the rest of the economy. Compared to that, the stock exchanges are around 75 lakh crore now. And whatever we see on BSE is real time mark to market, no NPAs, right? So I just wanted you to be aware that this is a different type of institution, different types of importance. When I came into this hall today, 3 questions people asked me, saying what is happening to this building? Is this building going to be closed down or broken? Because we have been reading in newspapers and television that this building is being demolished. Let me assure you that this building is not being demolished. There are few floors where there were few partitions that have been demolished. However, as usual in healthy democracy, we need to have exaggeration in media, which is what keeps on happening. But since you are sitting here, I thought you also have a proof firsthand that this building exists. It's not been demolished. Second question which I was asked is that BSE has had a huge glitches, technical glitches, which is there in all newspapers even today morning. Let me assure you that BSE today morning started well, and the trading is going on. By the time I came here, BSE had received around 2 crore orders. BSE has changed its trading system from Monday onwards in equities market, that is 3 days back, and it is now able to handle 5 lakh orders in a second. 5 lakh orders in a second is unheard of in India. When IRCTC, that is the railway booking, when we do, if IRCTC does 5,20,000 bookings in one day, it's a major news in all newspapers. When BSE does 5 lakh orders in 1 second, it is not a news. But the technical glitches is a news. The way we look at it is we give you response time in 200 microseconds. 200 microseconds is not a human scale. In 1 second, there are 10 lakh microseconds. By the time you close your eyes and open, we give you response time 10,000 times faster than that. And that has actually been implemented this week onwards, Monday onwards. India has been now put on the best, on par with the best in the world. And I just wanted you to be aware that BSE is back. BSE is back with a bang. For 20 years, BSE was slow compared to any other exchange in the country. And in this business, the first bird gets the worm. People used to go to other exchanges because BSE was slow. In '94, when NSE came, this floor was still working. Response time was around 30 minutes for an investor, even the fastest investor sitting outside of BSE building. NSE had a response time of around 2 seconds. For last 4 years back, BSE had a response time of around 300 milliseconds. NSE had a response time of 10 milliseconds. A year back, BSE had a response time of 2 milliseconds, 10 milliseconds, and NSE had response time of 2 milliseconds. Every time NSE was ahead. This is the first time that now BSE is 10 times faster than NSE. 10 times. And in next 3 years, it will be 100 times faster. We'll give 20 microsecond response time to every investor, and we don't give any special consideration to any large or small investors. Everyone gets the same information, same time, and same way. We don't give differentiation in terms of treating large people better, and that is why BSE is still the largest retail organization there is in India, with 2.5 crore customers registered with Bombay Stock Exchange. It is important for me to have talked about this because this is the first conference I am speaking after we went live. And last 2 days I was actually trying to repair what was sort of going wrong. Today morning when we started from 9:15 pre-open to open, it has worked out really well. So and thank you very much for all the brokers who have supported us in this endeavor in changing BSE's technology. I hope LIC and many other institutions who have been using our services will get even better services going forward. Third question was, what is happening on your SME platform? Why SME is so important to you? SME is a very important activity for the for India as a whole. India needs to create 1.5 crore new jobs for next 20 years every year. So in next 20 years, we need to create 30 crore new jobs. And those jobs cannot be created by investing in gold, silver, real estate, and so on and so forth. They can be only created by putting money in banks, by putting money in mutual funds, by putting money in stocks directly. Because the companies actually create jobs. Gold goes into the vault. It doesn't create jobs. India's first job for next 20 years, for whoever comes as a Prime Minister, is to create jobs. There is no other major activity that India needs to create. And for creating jobs, SMEs are the best vehicle. Per crore invested, the small and medium-sized companies create many more jobs than large companies. Large companies may set up 50,000 crore rupees plant with 2,000 employees. While as SMEs, even small SMEs are known to employ 2,000, 5,000, 10,000 people. And that is where the SMEs are extremely important to India. SEBI recognized this fact around 4 years back. They came out with the regulations. They told BSE to set up this framework, which is separate, although there was also a worry, a lurking worry in our minds and also SEBI's minds, that many of these companies have a tendency to fail faster because they are small. And small investors in 90s had invested in these many small companies and they actually vanished. So we used to call them vanishing companies. So we had to develop this SME platform very carefully. We said that we'll create a platform which will actually not allow small investors to invest. So we are meeting a legitimate need of financing, raising equity capital, even debt capital by SMEs, but not from small investors. Large investors who can take care of themselves, who can study, who can understand the business models and invest. So minimum lot size was kept as 1 lakh rupees. Today also it is 1 lakh rupees. SMEs also have two-way market making as specified by SEBI. Many of us, including brokers, exchanges, opposed the compulsory market making. But sir, now I confess that we were wrong, and we think that market making should be made compulsory for almost all stocks in Indian markets. We have not been able to add new investors in last 20 years in Indian stock markets, primarily because we have not been able to give them liquidity. We have not been able to give them exit. And we need liquidity by way of market making, which has been amply proven in 55 companies. Again, let me tell you that these 55 companies have reached a market cap of $1 billion. $1 billion of wealth has been created for small and medium sector enterprises. And for me, this is a small little NASDAQ that has been created in India. In fact, yesterday also we had a roundtable in this same hall with SME players, and many of them said, why are you calling it SME? Why don't you have aspirational name? It should be something very different. We have agreed to that proposal. We will come out with a very interesting name. But for me, whatever name you call it, it will still remain SME. It will still remain India's hope. It will still remain a growth of engine for India. It will create jobs for India. And for me, that is absolutely important compared to the names you give. In SME itself, we have more than 90% market share, 95% market share in terms of number of companies. 55 companies have been listed. 14 more will be listed in next month. Every day new SME players are coming. Compared to the IPO markets which has been dried up in the main board, now in SMEs you can see huge number of people wanting to participate. With that, coming to the sort of outlook for the rest of the country, as I said, job creation is absolutely important. That is the main job of a government. It needs to create policies which create jobs. Second is infrastructure. Without infrastructure, it's difficult to create jobs and create policies for that. And so that's why infrastructure is second part. Third part is skilling. We have 50% or more people below age 25. Out of 130 crore people, 65 crore people are below age 25. Those people need to get skilled. And earlier, we used to have education from age 0 to 22, 23, and then work for rest of your life. Because the skills you gather was actually working out for rest of your life. Today, literally every 5 years, newer changes, newer technologies, newer ways of doing things is going to take place. In next 20 years, 70% of the jobs will be such that we have not even thought today. 70% of the jobs have not been thought about today, which will be available in next 20 years. And we need to ensure that all our youngsters have an ability to understand newer things, get themselves skilled every 5 years so that they become relevant and they actually remain in the workforce. Otherwise, we will have a huge number of what we call demographic dividend of all these youth which is coming. It could become a demographic tax. China, US, everyone is looking up. Yesterday markets went really well everywhere else. Market has actually opened very well today in India also. But effectively, we need to be worried about some of the bottlenecks which actually our society has created and how we resolve them. I hope this seminar will allow us to ponder about this, think about this, and also come out with solutions. I again congratulate IMC for organizing this seminar. Thank you very much for coming today morning.
Thank you, sir, for your valuable insights. Mrs. Deena Mehta is a stock market professional for the last 3 decades. By qualification, she is an MBA in finance and an associate member of the Institute of Chartered Accountants of India. Several organizations have awarded her for the contribution to capital markets, including JC's International as Outstanding Young Person, IMC for contribution to banking and finance, Z Business for contribution to capital markets. I now request Ms. Deena Mehta, Chairperson, Capital Markets Committee, to give us a brief overview of the seminar and also to take us through the proceedings of the seminar.
Shri U.K. Sinha, Chairman SEBI, Mr. S.K. Roy, Chairman LIC, Mr. Vaidya, Chairman IMC, Mr. Pramod Thakkar, President-elect IMC, Ashish Chawan, CEO of BSE, my colleague Mr. Ashokan, Co-Chairperson of Capital Market Committee, Mr. Atul Mehta of ICI, and Mr. Arvind Pradhan, Director General of IMC, and all ladies and gentlemen present here. It gives me a great pleasure to have one more outlook for the year, and thanks to SEBI Chairman whom we always approach first to give the date for the seminar, and he gives in the first week of April. So we are lucky that at the beginning of the financial year we have this program. This is the 3rd year that SEBI Chairman has agreed to our request to be part of the seminar, and I am really thankful for that. Because increasingly we have seen that there are so many factors that affect the trends in the market, and regulation is a very, very big factor that affects the share prices. Though SEBI would not like to take debit or credit for the movement in the share prices, but be it disclosure of pledged shares, or be it movement of shares into an auction system, everything that the regulator does have impact on the prices. So we felt that regulators need to be very much part of our seminar. So we always start with SEBI chairman to set the ball rolling, and thereafter the entire program is set up. To briefly talk about the Capital Market Committee of IMC, I am happy to say that thanks to all the committee members who are very active on the committee, we do lot of programs for two class of people. One is the investors and second is the market participants. For the investors, we had several programs since July, which is the year in which the IMC starts the work. We had a program on risk and returns in small cap and mid cap companies, how to invest in indices, how to invest in volatile markets. I think that was the first program in which Mr. Navneet Munot, who happens to be here, and he really predicted that the index would rise like this. So I am happy to say that we started the year with on a very positive note, and today as we stand, we are at the highest index that the Indian capital markets have seen. Then we had investment in distressed assets, how to read ratings, how ratings are done, and which would really give guidance to the investors on how to go about what goes into rating. That was a very good program. We also had a program where we invited all the consulate generals of US, UK, Japan, and asked them what was their expectation, and really eye-opening suggestions came up, like putting a pipeline from Canada to India, because the demand for gas is going to go down in US, so all the surplus gas of Canada could flow all the way to India. And of course Germany talked about not having so many MBAs in India, but having more people who are skilled in various kinds of jobs, like assembling of a car, which is of course the forte of Germany. So they laid lot of emphasis on the developing skill sets of Indians. We also had a program to impress upon the CFOs, making of a CFO, which was a program in which how important corporate governance and financial disclosures is for a company to follow, so that the investors who invest in the companies, they are actually able to get a good deal, and there is full transparency in that investment. So it was a 2-day seminar. We also had a program on how to use proxy advisory services so that investors can vote wisely. So these were some of the programs which were there relating to investors, for those investors who are already invested in the market, and we gave them various options on investments. We also have an investor club, and I am happy to say that the members' age range from 16 years to 70 years. This is the wide range of members demographic which we have, and we talked about things like how to do financial planning, how to buy insurance, be it life, medical or general, how to read newspaper quotations, how to read balance sheets, and basic functioning of stock markets, mutual fund, ETFs and other things. So these were the programs that we had. We also made several representations to SEBI, sir, and I am happy to say that most of our representations during this year got accepted, because year before last we talked about REITs, which was the real estate fund, and SEBI chairman had said that we have considered and rejected the proposal. Then we talked about it the next year, and he said yes, we are open, please bring your suggestions. And now we are in the following year, and REITs has already been implemented. So I think you should give a big hand to SEBI on this major development which has happened in the Indian markets. We gave representation on amendment to the stock option schemes, creeping acquisition limits for shareholders. We gave a representation on the holding de jure control under the SEBI guidelines. Then challenges and difficulties faced in complying with SEBI circular on scheme of arrangement under Companies Act. Then SEBI circular on scheme of arrangement same under Companies Act. Then presentation to SEBI committee on depositories. And last but not the least, we gave suggestions on how to increase the DMAT customer base to 5 crore. There is a lot of possibility in linking of the Aadhaar database, the bank's KYC and the KRA. If these three systems are linked, it is very much possible to very easily increase our depository DMAT holders. Though lot of simplification has happened in case of KYC, but still there is a lot of people do feel it as a mental block to go about doing the paperwork for the depository services. So I think if any one KYC in banking industry or Aadhaar is there, if we can link it up, then it will be very easy to ramp up the number of Demat account holders who are there in India. So these are some of the suggestions that we have given to SEBI, and I am happy to say that SEBI has been very, very open in accepting our suggestions. There are a lot of meetings with the market participants in which these suggestions are passed on, and we do manage to get a lot of things through to iron out the operational difficulties which are there in the markets. Talking about today's seminar, I am very happy to say that this seminar is, we have almost 35 speakers who are there in the seminar, and we are really thankful to all the speakers who very readily agreed. In fact, I am happy to say that Mr. Gary Anderson has come all the way from Dubai who is the CEO of DGCX to talk about the commodity markets in India. We are going to cover 5 asset classes which we thought were really very important. So these are the assets which are tracked by the retail as well as the institutional investors. We have equity, we have money markets, we have commodities, real estate, as well as currency markets. Lot of thanks to the currency exchanges which have been set up, lot of retail investors are now getting involved into currency markets, and there is lot of appreciation of the impact of currency markets and money markets on the equity markets. I don't think 5 years ago or 10 years ago when the RBI policy announcement used to happen, there used to be so much talk about a 25 basis point interest rate here and there, and the index moving up by 200-300 points. So this is something which is thanks to the sensitivity which has been created by the media as well as by the exchanges which have come about, which is really having so much impact on the equity markets today. So the entire day we are going to spend, there will be 6 panelists in each of the panels, so they would all talk about what they feel is going to be the major trends. Of course, their organizations may not permit them to say that gold will be A price or the agri commodity could be B price, but at the same time they would talk about the factors which is affecting all these markets and what are the major trends that we are going to see in the markets. So that, ladies and gentlemen, is about today's seminar. We are going to be very strict about the timings, so I request all of you to finish your tea, lunch, etc. all on time, and I would take this program further by a new initiative that Indian Merchants Chamber has taken, and that is to honor long-term investors into this market. And we felt that with algo trading coming in, the vision of the investor has really become very, very short, and people want to just turn in 5 minutes, 10 minutes, 1 day, 2 day, and the whole concept of long-term investments is going away from the market. Warren Buffett has rightly said that it is not the timing that you enter the market, but the amount of time that you spend in the market, that is really what would decide on what is the kind of returns that you will get in the markets. So we take this opportunity to honor LIC of India, which we feel is the biggest investor, and being the biggest, it has really been an organization which has followed a very long-term policy in investing in India. I would like to read out the certificate which I would request Mr. Shailesh Vaidya, President of IMC, as well as Mr. UK Sinha to hand it over to Mr. SK Roy. Certificate, please. This is a certificate of honor which is given by the Indian Merchants Chamber to life insurance Life Insurance Corporation has contributed immensely to the development of capital markets in India. We would like to take this opportunity to acknowledge and honor LIC for their pioneering efforts in providing the backbone to the entire financial markets. The long-term vision of LIC's investment team has given depth to the markets. LIC has not only provided security to policyholders but also good returns on their investments. Accepted by Shri S.K. Roy, Chairman, Life Insurance Corporation.
Shri U.K. Sinha sir, Mr. Shailesh Vaidya, Mr. Chauhan, Mrs. Mehta, other dignitaries on the dais, and ladies and gentlemen, it's my great privilege to receive this felicitation on behalf of LIC of India. As Mrs. Mehta has just now mentioned, that LIC is possibly the longest tenure investor in the market. There are three things which I suppose make this happen. The first is that we are the largest life insurance company in the world in terms of customers served. So that gives us the scale of operations, the monies which are our investable surpluses which are invested in the equity markets. So this is a great privilege for LIC that we have this privilege of being the largest life insurance company in the world. The second important thing is that we are trustees of the monies of the policyholders, as just now the certificate read out by Mrs. Mehta mentioned. When we are trustees of policyholders' money, and I can say in addition to this also the other stakeholders' monies, then it gives upon us an additional responsibility of managing those funds with great deal of prudence, and sometimes this prudence borders on conservatism. That is one thing we often hear, that LIC is very conservative. I want to mention that this is because of the burden of expectations that approximately 30 crore individuals in this country and the large corporate world which trusts LIC with their monies. The third thing that I feel, I should mention here is that we are being honored and felicitated for being long-term investors. This is also on account of the nature of work that we do. A life insurance contract is typically a long-term contract, and therefore the investments of the corporation have to match with the tenure of the contract that we have with our policyholders. So these are three broad factors which prompt us to work in the manner we do. It's always our efforts to ensure that we return to our policyholders and stakeholders a good return on what monies they have given us to manage on their behalf. Last 57.5 years have been a very exciting journey. I'm sure the next 58 years and thereafter will be equally challenging and interesting. I thank IMC on behalf of the entire team of LIC of India for this great honor. Thank you very much.
It gives me great pleasure to introduce Shri U.K. Sinha. I think I am one of the few persons in this hall who has had the distinction of interacting with all the SEBI chairmen after SEBI was formed and even before SEBI was formed. So I have been very fortunate in this regard, and the entire evolution of SEBI which has happened over these years is I think unparalleled in the world. The number of years which SEC took to get its act together, and if we compare it with how fast SEBI really became a force to reckon with, and especially the change that we have seen in the broking community especially, from an extreme no compliance kind of a scenario to a huge compliance kind of scenario. I think it's all thanks to SEBI, and there have been huge benefits because of good regulation which the entire community and the markets have followed. I think the biggest beneficiary is the FII investments which have come to this country is essentially because the good regulation that the market participants have followed over the years. And from a turnover like 600 crore a day during Harshad Mehta's time and 200 crore a day average turnover before in the 80s, we are today at 3 lakh plus crore turnover. I think this huge change which has happened is all thanks to the good regulatory environment which has been promoted especially by SEBI in India. Talking of Mr. UK Sinha, I think he is one of the rare persons who has been on all the chairs and on all sides of the table so far as regulation and market participation is concerned. As a person who was heading the capital markets in Ministry of Finance, then going into UTI, because I remember at the mutual fund seminars how Mr. Sinha would appeal to SEBI to really change their policies in order to have more changes in the mutual fund environment, and then again coming on the other side of table and influencing regulation. And another major change which I have at least seen in SEBI and which all of you would all have also seen, and that is earlier SEBI used to take a stand that this is my intermediary and I will not go beyond the regulations which I have. But the bold stand taken by Mr. Sinha in regulating the fixed deposits and other cheat fund and other companies and what scam happened in Kolkata, I think is a major shift which is there in SEBI in going beyond their mandate and trying to ensure that it is not just the capital market and the intermediaries which are controlled by SEBI, but if anything wrong happens in the entire system in relation to the savings of the investors, SEBI will not hesitate, it will step in and it will take responsibility and it will see to it that the trust which is there of the investors in the market is restored, be it under SEBI regulation or not under SEBI regulation. So I think we really need to thank Mr. Sinha for giving this bold face to SEBI and moving towards a regulation not of just of security markets but financial markets totally. And I am sure with the new extension of another 3 years, we will see lot of changes which will at least eliminate totally the operational risks. I think we have come a long way in totally eliminating operational risks in investment in security markets, and hopefully moving forward, things like company managements and other things which are of course lot under control, but we would see better scenario in terms of insider trading and price manipulation and other things. So I would now request Mr. Sinha to kindly deliver us the inaugural talk. Thank you very much.
Mr. Shailesh Vaidya, Mr. S.K. Roy, Ashish Kumar Chauhan, Mrs. Deena Mehta, Mr. Prabodh Thakkar, Mr. Atul Mehta, Mr. Ashokan, ladies and gentlemen. IMC has, as its chairperson of the Capital Market Committee, a person who is not only very knowledgeable about the market and has long association, but also a person who has been championing the cause of the growth of the market, and she has been a person who has been meeting everybody who matters, whether it is the government or the regulator or the media, about what changes should be brought about in the market. She brings a huge amount of passion in the task that she has given to herself. So it is very difficult for me in particular to say no when she has been inviting me here. and I acknowledge that this is for the third time together in continuation that I am here. Now my difficulty is that if I am coming here year after year and this is the third year, then what should I be talking to you about? It's very difficult for me because I can't generate a new topic or a new subject or a new issue whenever I come. So many of you will perhaps find that what I am going to say is dull and boring. But what I thought I will be talking here today is about what SEBI has been doing in the last 3 years and what has been guiding SEBI on those lines, what has been our guiding principle. Let me begin with capital raising. We all know that primary market has been rather muted in India in the last 3 or even last 4 years. The statistics are known to you, but if you look at 10-11 onwards, every year the market has been rather muted from a volume of about 58,000 crores in the primary market in 10-11. We have been hovering in the range of 13 to 15,000 crores. And that also includes the rights issue. But more important, and this is something which I would hope that all of you will ponder, that in the last 3 years, there have been huge amounts of DRHP filed with SEBI and they have been withdrawn. DRHP filed with SEBI where SEBI has given the approval, but the corporates have decided not to raise the money and they have allowed it to lapse. In last 3 years, that amount is close to around 60,000 crores. So in our country, and it has been going on for last 3 years, if corporates initially started by planning that they need to raise capital, they have given their fees to SEBI, they have incurred other expenses, and ultimately they decide to forego their fees and to allow the approval to lapse. It shows a very important dimension that the appetite for raising capital has dwindled. And while the role and function of SEBI is limited to what we can do in our arena, I think the larger question is what needs to be done so that the environment again comes up. I would like to assure all of you that so far as we are concerned, undeterred by these developments, we have had serious interactions with market players, with corporates, with professionals, and we have brought about a number of changes so that whenever the mood changes, whenever people want to raise money, they find that our system is helpful to them. We have, for example, decided that any retail investor who is applying in an IPO, he will be getting compulsory allotment, which was not there earlier. We have allowed, for example, that in more than 1,000 places, ASBA will be there. So applications which are supported by blocked amounts, that will be there. We have taken measures to enforce e-IPO, electronic IPO. And having said that, I would like to narrate that if there are any further demands, if there are any further suggestions which we can do for the growth of the IPO market, we are more than happy to listen to you. We will be very happy to consider that. So at the end of your deliberations today, at the end of the seminar, like last year, I am sure Mrs. Mehta will be giving us her comments and suggestions, and I would like to assure you that we will be getting into it. Ashish has told you about the work done by BSE in the area of SME platform. I would definitely like to compliment BSE for what they have done in this area, because from next to nowhere, creating companies with market cap of more than $1 billion, it's a huge achievement. Nobody could have imagined when 2 years back this whole idea came up and we came out with our detailed regulations that we can have a separate platform for SMEs. And let us not forget that this is not the first attempt. There have been several attempts. I remember one attempt when I was in the ministry and we had started it in BSE. But there were certain design problems. Maybe we were ahead of the time, or something we did which was not correct. But to have a system which is in place, where small and medium enterprises, their combined market cap of companies listed in BSE alone has crossed $1 billion, is something, a matter of great satisfaction for all of us. And Ashish has told us that there are many other companies lining up. I would also like to say that the other initiative taken by SEBI with regard to an IPO without listing, by having an institutional platform, that we have issued our guidelines in October 2013, and I am happy that in 6 months, 3 companies have already got listed here, listed here on the Bombay Stock Exchange institutional trading platform. And the good thing about this initiative is that this allows, qualified institutional bidders, private equity, venture capitals to find a ready exit opportunity. So I am expecting that once this platform also succeeds, venture capitals and private equity will find it perhaps better to start getting their companies listed here, so that they can find a very good price discovery and they will find liquidity. Friends, 2 of the previous speakers, Mrs. Mehta and Ashish, today have mentioned that at some stage of the development of certain products or certain initiatives, SEBI was acting as if it was spoiling the show. But today they are saying that in hindsight it has come out that it was perhaps the right decision. So friends, our job is not to be spoiling the show. Our job is to ensure that the trust, LIC chairman rightly talked about the trust given by his policy holders to LIC. Our job is to ensure that the trust which people have in the market is strengthened further. I remember when we were talking about compulsory market making, there were huge pushbacks, and the demand was that this whole thing will fail. But today I am happy that the market has acknowledged that it is perhaps the right thing to do. Similarly, what Mrs. Mehta talked about SEBI's creation and the view or the reaction of the broking community and the situation now. So we all have to move forward in this direction. I would like to say that our job is also to ensure that we make the system more friendly to the investors. The ease and convenience which people have by trading in the market should be improved. Rightly a point has been made about making the KYC more simple. I am happy to tell you that we are in constant dialogue with other regulators, and the end destination is that an investor in India or a person who is opening a bank account or a person who is going for an insurance product should not have to go through several KYCs across segments, across markets. That dialogue is going on, but you must appreciate also that this is a very huge task. And no country has been able to do it successfully. No country. So please bear with us that it will take a little more time. But as a first step, after we started our KYC registration authority, KRAs, so now the next step is that if somebody is an investor in a mutual fund industry and somebody has also got a DP account, then we must be able to provide him a statement of account which will give him the complete picture of his mutual fund investment and also his holding in the securities directly. That is the project on which we are working very seriously. It will be wrong for me to give you any time frame, but hopefully it will happen very soon and definitely not beyond the end of this particular year. We have taken a number of measures for investor protection. It's not a forum to narrate all of that, but I would like to mention that in matters of investor protection, our approach has been to reach out to the investor at multiple places. So in last 2 years, we have opened 16 offices, and our offices have been empowered to deal with investor grievances and problems of the investors. on matters of arbitration, matters of grievance redressal, the arbitration mechanism in the stock exchanges, you will be noticing that in the last 2 years, last 3 years, we have made lot of improvements and lot of changes. I would like to talk to you a little bit about our regulations on foreign portfolio investors. In 93-94, when the foreign institutional investor regulations came up in India, this was an experiment and the economy had just opened up. But we felt that now the time has come that there is no need to restrict the non-residents to invest only through a FII account or a sub-account. And I happened to be chairing that committee on behalf of the government in 2010, which recommended that all non-residents should be able to invest in India. And the only requirement which my committee had recommended was that there should be a solid KYC. So I am happy that now SEBI has come out with the detailed guidelines that now FII regulations will migrate into FPI regulation. Forget the nomenclature, the whole idea is that any non-resident can now invest in the Indian market. He need not come, for example, he need not come to SEBI for registration. We have authorized depository participants of a certain standing to start registering them on our behalf. As you know, in equity market, there are no restrictions about how much money you can bring in and when you can take it out or when you can take out your profits. All those things have been done. I'm happy to acknowledge that the Central Board of Direct Taxes and the Ministry of Finance have also notified that the same tax treatment will be given to the FPIs which was available to the FIIs. And last week, Reserve Bank of India has come out with its guidelines aligning the KYC requirements of SEBI for all the FPI regulations. So all the FPI investors will have the same KYC requirement when it comes to a matter of opening a bank account by an FPI on the lines of SEBI's KYC. And the KYC requirement for the foreign portfolio investors have been simplified and it has been made risk-based. I'm sure many of you would be aware that earlier if somebody wanted to be a foreign portfolio investor in India, the KYC was so cumbersome that in certain cases the passport details of all the office bearers of that particular company were required. In certain cases one had to travel to the embassy to get a notarization done. All those things have been done away with. Now we have made it very, very simple and the details are available for all of you, and it has been rightly acknowledged that the directions of the government and the directions of SEBI are in every manner to promote that investment. In order to generate trust, SEBI has also been focusing on the area of corporate governance. Again, one mention has been made by my earlier speaker. We have made several other improvements, and our corporate governance guidelines will become effective from 1st of October. You are also aware that what changes have been brought about by the Company Act. Without getting into details on how the remuneration will be fixed up or who is an independent director, one point I would like to highlight here is our focus and worry on matters of related party transactions. So if you look at our circular, if you look at our press note, that is one area where we are really trying to focus, that on matters of related party transactions, there have to be very clear-cut procedure about approvals, and also we have gone into the system of approval from the minorities as well. In the currency market, and because of the 5 asset classes that have been talked, there has been a mention of the currency market also. I am happy that while the currency futures market are doing well in the country, last year and also in 2012, in consultation with Reserve Bank of India, we had to place certain restrictions because of the volatility in the rupee. I am happy, and I am sure many of you are aware that 3 days back we have come out with our new guidelines whereby we have restored, for example, the margin requirements. So margin requirements have been substantially reduced. We have also now come out that with a requirement, with an approval that the timings of the currency market can also be now enhanced from 5 p.m. to 7:30 p.m. So we are moving in a direction where the Indian currency derivative markets can help the corporates, for example, to hedge on a continuous basis. This is one small step in that direction. A mention has been made about REITs. Our board has taken the decision. However, the actual implementation will depend upon the tax treatment which is given to REITs. So we have represented to the government, and I'm reasonably assured that whenever the next finance bill is presented in the parliament, this will perhaps find a mention. We have taken it up very strongly with the government, so that if the tax treatment is clarified, then the REITs can definitely progress. We are also coming out with some new guidelines on matters like crowdfunding, because we wanted to encourage young entrepreneurs, technology entrepreneurs to be able to raise capital. Our main effort is, number one, to help younger people, new entrepreneurs to raise capital very smoothly, and at the other end our aim is to ensure that the investor is treated in a fair way. I will be looking forward to receiving the suggestions of this seminar, and Mrs. Mehta has given us good marks that whatever she had recommended earlier, SEBI has been able to implement a good percentage. Mrs. Mehta, I would like to assure you that this time we will try to improve even better than what we have done in the past. Thank you for inviting me.
Thank you, sir. I request Mr. Shailesh Vaidya to hand over a memento to our chief guest, Mr. UK Sinha. I request Mr. Prabodh Thakkar to hand over a memento to Mr. Ashish Kumar Chauhan and Mr. Atul Mehta. I now invite Mr. Atul Mehta, Council Member, ICSI, to present a vote of thanks.
Friends, it gives me immense pleasure to propose the vote of thanks at the first inaugural session of Investment Outlook 2014. And firstly, I express my sincere gratitude to Mr. UK Sinha for chairing the session at the inaugural session. And as Dinaben rightly said, for a good capital market you need a good regulator. And of course, good regulator means you have so many regulations, either by way of rules or notification and circular. And let me assure you, sir, as an Institute of Company Secretaries of India, all our members are there to implement those the regulations and the Act in a total spirit. Again, a special thanks to Mr. S.K. Roy, the Chairman LIC, to be part of this, and compliments for getting those guests of honor from the IMC. My also special thanks to Ashish Bhai Chauhan, CEO BSE, and very happy to note that we are the fastest exchange compared to the other exchange. Again, a thanks to Shailesh Bhai for organizing this wonderful event. Again, thanks to Dinaben for organizing this program, and of course Prabodh Bhai and Ashokan for this program, part of this programs. And also would like to thanks the staff of Indian Merchant Chamber. A special thanks to Kinjal and her team, and also I would like to thanks the staff of Bombay Stock Exchange. With this, we are breaking for the tea. Thank you. Sorry, we are starting immediately the next session. Sorry, thank you. Oh, there is no tea break. Sorry.
I request the dignitaries on the dais to pose for a group photograph. We will now begin our session on commodity markets. I request Mr. G. Chandrasekhar, moderator of this session, to come on the dais. Mr. Chandrasekhar is the associate editor of the Hindu Business Line, Agriculture. Newspaper is a specialist in food, agribusiness and commodity markets. I would now like to invite our honorable panelists, Mr. Gary Anderson, CEO, DGCX, Ms. Kaveri Deshmukh, Senior Economics, NCDX, Mr. Ashutosh Deshpande, VP, SR Energy, and Mr. Hitesh Avachat, Group Head, Metals and Mining's, Care Ratings. I request the audience to please settle down so we can start with the panel discussion. I now hand over the floor to Mr. G. Chandrasekhar to moderate the seminar.
Morning friends, it's such a delight to be here. Wonderful ambience, absolutely vibrant. I have always believed India's economic growth over the next 25 to 30 years is going to be driven by commodities, the commodity sector. Be it agriculture commodities, be it metals, be it energy products, these commodities are going to be an integral part of India's economic growth story. And obviously commodities have now emerged as a major asset class, and there is huge economic interest in the commodities market. This morning we are going to discuss investment outlook as far as commodities are concerned as an asset class. We have some very distinguished speakers who are experts in their own field. Without much ado, now I'm going to straight away invite my friend Gary Anderson, CEO of DGCX, to deliver the keynote speech, which will be followed by some expert presentations. First, it will be on the crude market by Ashutosh from SR. It will be followed by Hitesh, who will speak on the base metals. Then comes my friend and former colleague Gargi. She'll speak on gold, and of course Kaveri from NCDEX will speak on agriculture commodities. I'll try and round up the proceedings of this session at the end of this. Therefore, Gary, the floor is yours, the keynote speech. Thank you.
Thank you. When I had a call with Dina a couple of weeks ago, and we were going through, the content of the panel and what should be in it. And vaguely she said it's about commodities. You can, talk about anything, the structure, the regulatory regime, the prices, your outlook, and all those kind of things. Well, there's so much going on within commodities, as we know. There are many changes going on globally, not just in pure terms of supply and demand, but also in terms of the way the structure of these commodity markets are organized, which we are seeing a transfer from the investment banks to the commodities trading houses themselves. And although we are seeing in this part of the world a huge investment into commodities, a statistic which perhaps contradicts that is that last year in 2013, over $50 billion were poured out of investment funds in commodities globally. One of those big funds is PIMCO, which is one of the largest bond funds in the world, and they have this commodity fund which had around $19 billion invested within it, and it lost 25%. And again, from an index perspective, commodities have been down this last couple of years. So in terms of the outlook, it's going to be very difficult to analyze. And for me personally, I'm going to give you an overview about how I see things, because as an exchange, I can't give you investment advice. We rely on the volatility and provide that platform for risk mitigation and also transparency of price itself. The other thing I will let you know about my history is that I'm not an economist either. So what I'm coming across with this morning is purely my observations of how commodities will look in 2014. But before I continue, I'd like to say thank you to the Indian Merchants Chambers for inviting me here this morning. It's a great pleasure to be a part of this conference and to be here in Mumbai at the BSE on the original trading floor, which is a place I feel very comfortable within. When I started my career many years ago, it was basically London and New York. And I started off trading gas oil and coffee eventually. And so the focus was very much in London in the AM, and again waiting for the presence of the US to come in the afternoon. I really didn't think about Shanghai, Singapore, Tokyo, Hong Kong at all. These were just places that were far away that hopefully at some point in the future I would see. But if we fast forward 30 years, we now see that Asia has become a dominant force within the commodities marketplace. When I was researching for this particular panel, I came across a research note from ANZ, the Australian bank, which basically turned that this was the time for the Asian century. By 2050, Asia would account for more than 50% of the world's GDP. And in 2050, Asia's financial system will dwarf all others and probably will be 4 times that of the US and Europe combined. And these are just absolutely incredible statistics. And this is going to be driven largely by the Asian demand, especially from the biggest economies, India and China. And since the year 2000, commodity prices, as we all know, have been, or has been labelled as in this super cycle move, up until most recently. However, the global economic backdrop is changing as we speak. In 2013, the economy, or the outlook for the world economy, finally started to brighten. In the US, there was some signs of growth, and again, I think the latter part of 2013, we have seen that come to the fore, and there is non-farm payrolls appear to be growing, and so the economy there in the US is actually going into positive territory. The euro area is still what seems to be very stagnant and struggling to find any kind of inflation whatsoever. Some analysts even believe that the shift in commodity markets from developed countries to emerging markets is beginning to reverse because of these developments. China's economy, on the other hand, in 2013 slowed. And that has a big impact because I don't think the world has adjusted to the supply and demand
or certainly the demand from China itself, we have yet to adjust for what they can achieve. And as I said, their economy has slowed down in 2013, and even this morning there were some import-export numbers that came out of China. Their exports were down 11%, and their imports again down 6%. So not a very good situation in China, despite them trying to basically add more money into the system itself. I think there are four key themes really for 2014 with regards to commodities, and which are important for this part of the world. Firstly, especially within the GCC, there's the possibility of reduced geopolitical risk following the Iran nuclear talks. The geopolitical situation in the Middle East remains high on the list of issues to keep an eye on in 2014. The outcome of negotiations between Iran and the West over the country's nuclear program will be paramount for a risk factor in Middle East oil. The progress in nuclear talks creates reason for optimism and reason to be bearish on oil prices in 2014. However, the unresolved conflicts that are going on there in the region mean that the situation could easily deteriorate and lead to rising volatility in oil prices. Secondly, there is a risk of glut in commodities, and oil being again one of those, and potentially grains. There are a number of factors that could lead the world economy to an oil glut later this year. As we know, in 2013, the US and shale oil, world oil production has grown on the back of this shale boom and has obviously flooded the market locally. Supplies increased last year despite the Chinese economy slowing, and significant supply disruptions in Libya itself. Iran, Iraq and Libya all had publicly announced plans to significantly increase their output. If other major OPEC countries start worrying about their competitive position, prices could drop further than we basically think. The risk for oil, for me personally, is clearly on the downside. Elsewhere, the agricultural markets are preparing to be inundated by grains, oilseeds, and output is expected to be in record highs in some regions. US corn production could actually register its largest increase in almost 20 years as commercial farmers from across the world benefit from more favourable weather conditions. Although demand from emerging markets remains robust, world demand is likely to be outpaced by the substantial increase in supplies, perhaps tilting the market balance upwards. My third observation is the global economic recovery should be good news for base metals. The US obviously leading that recovery and Europe slightly behind, but it's getting there eventually, which means there should be a pickup in the investment activity. And again, that really should in turn be positive for metals. As Europe is slowly getting back on its feet, as confidence returns, I think the outlook for the prices in commodities in general are going to look favourable. But again, as I said earlier on, with regards to China and its supply and demand factors, which we clearly do not understand or have yet to adjust to, anything is possible. My last theme really is that there are no real grand investment themes out there. You know, we are at the peak of a super cycle, it seems, and there is a massive surge in investor interest across commodities. But again, that kind of contradicts in some respects what the figures are coming out from the banks themselves. Investors are looking to diverse their portfolios very much more so. And again, I still genuinely believe that commodities will be a place where that can happen. In 2011 and 2012, interest was very much focused on precious metals, mainly gold due to its safe haven flows, because of the euro debt crisis and the fiat money, or the printing of money, by the US in particular. Over 2013, we have seen this interest waned as well, and there's substantial outflows of money from commodity funds and ETFs in general, and again in the middle of last year. One of the defining factors for commodity prices has been its extreme volatility, and again over a 10-year period it's probably doubled. Over the past 14 years, the average annual volatility of resources have grown 3 times compared to the early 90s, and that came from a McKinsey report published at the end of last year. I think this volatility will continue to be there as we start to adjust to these dynamics from Asia in particular. I'm going to just briefly talk about DGCX, Dubai Gold and Commodity Exchange, and obviously how we are participating in that and how we are looking to take advantage of those changes in the commodity flows throughout the world. So as an exchange, we are trying to develop those products that enable the end users, the producers, and everyone in the value chain to mitigate their risk, and also to have some kind of exposure, whether it be long or short, depending upon their views. And over the last few years, the Gulf region trade links with emerging Asian markets has grown incredibly, and at the expense of the US and Europe. India was the GCC's second largest export destination in 2012, followed by Korea and China. The Asian continent accounted for 57% of the GCC's total foreign trade. The Gulf region's exports into China rose by 9% in 2012. It was only 1% back in 1995, while exports to India rose 11% over the same period. Crude oil and gas dominate the GCC exports to developing Asian economies, accounting for nearly 80% of all what's traded. There are other vital commodities for us in the Middle East, and they are very interesting and again add to the trading dimension within Asia itself. Over the past few years, DGCX has listed gold, copper and plastics. Recently, some figures were issued for 2014 with regards to Dubai and the amount of imports and exports of gold in Dubai itself. By all accounts now, the volume of gold through Dubai is over 2,200 tons. And it makes Dubai one of the biggest gold hubs globally. And if those figures are correct, it's 40% of the world's gold now goes through Dubai. If you are a pessimist and just halve that figure and you think it's just 20%, well actually that's still a very, very significant number. We have again substantial trading links, the UAE, with India itself, and again gold is one of those commodities. The other contract that we listed most recently was plastics. Plastics again, 50 tons or 50 metric tons of plastics are produced within the GCC, and that now accounts for around 20% of the world's plastics production, of which 50% of that goes exported into China. And so we launched this contract not just for the Middle East but also for the rest of the world. It wasn't until recently the market participants did not have an opportunity to hedge their plastics risk, but now they do. Also, there's a huge trading copper that goes throughout the UAE in terms of production and also into Asia as well. India is the UAE's largest export market for copper, and copper is also one of the UAE's chief exports into China. So copper's sensitivity to today's economic environment has made it highly price volatile. So what we've done is provide tools to manage that price volatility. These are just a few examples of how commodity trading links between the Gulf region and emerging Asia are growing. Going forward, I am broadly optimistic that the recovery in the Asian markets, combined with the continued growth in the Middle Eastern markets, will fuel the expansion of our commodities markets. Commodity trading links between our regions will be a key driver of the expansion in the scope and scale of our economic ties. As our market grows, we will see new synergies and complementaries between our commodity sectors. I look forward to a productive and enriching discussion in today's panel session. Thank you very much for your attention. Thank you.